Wow, a lot more people. We're going to wait for people to join. Thank you for joining. We're going to have such a great time today. We have, I have so much planned for you, so much. You're going to be so excited today. I heard you. I heard what you've been asking me to do. And many of you have been asking me, I've talked about so many things. I've talked about bonds. I've breezed over stocks. I've talked about the economy, what a recession is. I've talked about how you can make money, and I've talked about so many things. Today, we're going to talk about the most exciting thing, and I'm going to hold until more people join. Hi guys. Hi, Mary Campbell. Hi, Janae. My friends on Instagram, you guys better go on YouTube. It's more fun over there. I can't really see your comments. I can see you and you can see me, but I can't really see your comments that much. So you should go to YouTube. And my friends who are already here on YouTube, please hit the subscribe button to make sure that you don't miss anything, because I've just started a series, and that series is going to cover investments, all of the most popular investments, and some investments you might not even know about, which you should be thinking about. And so you should definitely go subscribe to the channel. And my friends on Instagram, go subscribe. And my friends on YouTube, you guys should definitely hit the subscribe button. Okay, I'm gonna wait for a few minutes for a few more people to come in. Hi, Lady Good Good. That's a nice name. I see Leo Chick. Wow. I see A. Simon. I'm sorry, Monday's call. Somebody asked about Monday's call. I moved from Mondays to Wednesdays. And the reason why is because, as you know, I run a couple of businesses. I run a technology firm. We're trying to eliminate student loans. And we're going to be launching in about a month. And you'll be hearing more about that. I also have a financial services company. And so it's so busy coming into Monday that usually we're scrambling. I have to cancel a lot of meetings because I do a lot of preparation for you. And so we decided, Tuesday's a better day. It's hump day. People are calmer. It's not as much going on. So 2:00 on Tuesdays, on Wednesdays, is when we moved it to. So we'll wait for a few more people to come in on YouTube. Listening from London. Hi, Janine. Hi, London. It's so great to see all my friends out here. All my friends. So make sure you guys on Instagram, make sure you all go to YouTube so I can see you. But we'll give it another 30 seconds and we'll jump into probably the most exciting topic that I've talked about so far, and that's stocks. We're going to talk about stocks today. You've all been asking, you see my whiteboard over here? I'm going to draw stuff out for you. I'm going to run some numbers for you. And I'm going to show you how to pick a stock, how to really pick a stock. And then I'm going to ask you a question. Should you even be buying stocks? And I'm going to let you answer that question yourself. And the reason why is because there's other things you can do versus go pick individual stocks. There's things like mutual funds, index funds, and then I'm going to tell you where to go. Some people ask me about Robinhood, about Schwab, about E-Trade, about, financial advisors like Merrill Lynch and AXA advisors. And I tell them, I'll tell you today which one is right for you and the pros and the cons of each one. And let's see what else. So we'll talk about a lot, and, hopefully you'll learn a little bit from it. So let's start. Over the last month and a half, we have been in the midst of a recession, a very bad recession, probably the worst we've had since the Great Depression. Unemployment has increased dramatically. A lot of people have lost their jobs. People are at home. Business activity has plunged. And the stock market has plunged. It plunged massively all through between February and I'd say late March. In late March, on my social media channels, in person, I was telling people to go buy, because American companies are on sale. Whenever a company, something Macy's goes on sale, or there's a sale at Nordstrom's, what do? You pack your bags, you get into your car and you go to Nordstrom's and you go shop because you're getting stuff on sale. Well, some of the best and the most amazing American companies were on sale. They're still on sale for many of them, but pretty much all stocks were on sale. So I encouraged you to go buy, and some of you did, and some of you later on told me, you know what, Dave, it's one thing to ask me to go buy. It's another thing to tell me what to buy, where to buy, and whether or not I should buy. And I realized I'd made a mistake. I didn't tell you what to buy. I didn't tell you where to go. And I didn't tell you how much to pay, how to think about it. And so I'm going to do that today. I apologize if I didn't do that, but I'm going to do it today. And don't worry, there's still lots of opportunities out there for you to buy. And don't feel like you fear of missing out. You didn't miss out on anything. You could still get more. As long as you hold the stock for a long enough period, you're going to be good. So we're going to talk about stocks today. What's a stock? A stock is an ownership interest in a company. When you buy a stock of, say, Apple, and I'm not recommending Apple, I don't recommend individual stocks on social media. Just that's not what I do. I do it on a personal basis. And so if I mention a company today, I would strongly encourage you to go consult with your financial advisor, or go to your broker, or go online and do some more research, because even though I may talk about certain specific stocks, they may not be right for you in where you are in your life. And so please don't necessarily take these recommendations and go buy right away. I use the names of stocks as a generic way, just to talk about as an example. So if you own a piece of Apple, it means you will own a stock of Apple. So when Apple sells more phones, Apple has revenue. Revenue is how much they make from, they sell a phone for $1,000, you make $1,000. And Apple has expenses. Say Apple has those beautiful stores, they hire people, they have equipment, they have the cases, they have a lot of costs. So let's say the cost is 60%, as an example. The remaining $400, so the $1,000 revenue, $600 expenses, the remaining $400, that's the profit. You as an owner get a little piece of that profit. And that's what a stock means. A stock means you own a piece of a company and you get a piece of the company's profit whenever they sell. So a stock is an amazing way to make money. Well, I call it sleep money, because you're not working for it. Your money is working for you. What you're doing is you're basically in bed, drinking coffee, eating noodles, and those tens and tens of thousands of Apple employees are working really hard around the world to make money for you. And so that's what it means to own a stock. Now, one of my heroes, and I met him at Harvard Business School many years ago, in the mid-90s. He had a couple of sayings about stocks. He started with a few $100s. He built a $89 billion fortune. And I subscribe to a lot of the things he says. And his name is Warren Buffett. He has a few sayings about stocks. One of the things he says about stocks is there's 2 rules to buying stocks. 1, don't lose money. Number 2, don't forget rule number 1. So I'm going to show you today how to pick a stock. And as long as you recognize that when you buy a stock, you're buying an ownership interest in a company. A stock means when you buy a stock, you don't want to buy something that you sell tomorrow, or the day after, or next year, or the year after. When you buy a stock, you're buying into a company, a real life living organism with a lot of people working in it. So when you pick a stock, don't pick the fly-by-night stock, the one that you heard about in the dentist's office or in the lunchroom, or the one your colleagues are talking about. You want to do the research yourself. I'll show you how to do the research. I'll show you the things that you should look at. I'll show you how to pick really quickly a good stock or a not so good stock. And then I'll throw everything I just said out the window and I'll ask you, well, should you even be buying stocks? But first of all, let's talk about the things you should look for when you buy a stock. There's a lot of different things. Well, first, before I talk about that, it's one thing you should keep in mind. I have so many people who come into my office and they're looking to buy a stock, and they buy a stock, we buy it for them, and they get emotionally attached to it. It goes all the way up and it's time to sell, and they don't want to sell, because they emotionally are tied to it. I have some people here that grandpa bought a stock for them when they were 6 years old, and they get emotionally tied and they never want to sell it. I have some people who they get stock like CVS or other companies that give you stock inside your 401k or as a qualified option or an employee option. It's employee benefit. Many people get emotionally attached to those stocks. I have a rule: do not get emotional about stocks. The reason why is because a stock is an instrument for you to use to make money. It's not a lifestyle. You're not buying a stock because you don't work, because it makes you feel good. The only thing you want to do is to make money. So do not get emotional about stocks. So what are the things we should look for in a stock? I'm going to list a bunch of things you want to look for or you want to look at, but I'm only going to focus on two. And I have my chalkboard over here. I'm going to draw some numbers out for you, so you kind of understand the principle. I'm going to focus on just two, but there are a lot of things you want to understand, you want to do when you buy stock. The first thing is you want to understand the company, or you want to understand the product or the service they sell. You don't just buy a stock you don't understand. Why? Because how do you do research? If you don't understand a stock, how do you know whether it's a good buy or whether it's a good sell? There's some people who do what you call technical analysis. They look at, they use charts. They look at, break points. They look at, things like that. Well, that's all good and fine, but we use what you call fundamental analysis. We actually look at the stock and we ask the question, is it a good company? Can I hold this company in 20 or 30 or 40 years? Is it going to go bankrupt? Does it have a good credit rating? There's a bunch of things we look at when we buy a stock. And so we actually look at the company. And to look at a company, you have to understand the company. So before you buy a stock, make sure you understand the company, you understand the products, and you understand what they sell. If it's Apple, they sell phones. They also have service. They have iTunes. They have, they have a bunch of other things. That Apple TV. You have to understand those things. You have to know what you're buying. Don't just throw a dart and buy a company. It doesn't make any sense. Competitive advantage. The types of companies you want to buy are those companies that have a sustainable competitive advantage. The worst thing that can ever happen to a company is competitors, you start making money, competitors come in and they drive you out of business. Why? Because they can offer the stock cheaper, maybe a better service or whatever. You want to have a company, you want to have a stock, you want to buy a stock where there's a moat around it. You have a sustainable competitive advantage. And I'll give you an example. Apple, and I've used this example before. If you want to change to Samsung, guess what? You have to change. Apple has this thing called apps, right? And there's tens and tens and tens of thousands of apps. If you open up your phone, I bet you got a couple of dozen apps. I got like 45 or 50. If I switch over to Samsung, I would have to get rid of all these apps and re-download all my 45 or 50 apps. I don't want to do that. It's too much work. That is a sustainable competitive advantage because it's painful. You can change, but it's painful to change. So the second thing, in addition to understanding the company's product and service, the second thing to buying a stock is you want a stock that has a sustainable competitive advantage. So it's very difficult for competitors to come into its business. That way you can keep making money. The third thing you want to look at is recession-proof stocks. Many of you have heard about a lot of companies that have been going bankrupt. Some retailers, JCPenney just filed for bankruptcy. A lot of the oil companies in Texas and outside in South Dakota, they're filing for bankruptcy. And the recession hit and the income dropped, the expenses stayed high, and as a result, they filed for bankruptcy. You want to be very careful. When you pick a stock, make sure that stock is recession-proof. So no matter what happens, people are still going to keep buying this stock. And I'll give you an example. Milk, right? Are you going to stop drinking milk because there's a recession? No. Who sells milk? Walmart. Oh, maybe you should be looking at Walmart. Well, I'm not saying you should or you shouldn't. I just want you to get the sense. Or Pampers for babies. A recession happens. What are you going to start using for your baby? Toilet paper? No. You got to use those Pampers. So those companies that make Pampers, the consumer products companies that make Pampers are good to buy if you're looking at that aspect of buying a stock, which is recession-proof. consistent earnings. You want, when you're working, every year, you want your income to go up, right? There's inflation. That's the cost of goods and services go up. You also want to make money. If you're making 30,000, next year you want to make 32,000. If you're making 120,000, next year you want to make 125,000. You want your income to be going up. The same thing applies to a company. You want a company that has earnings and revenue that are going up every year. A good rule of thumb is somewhere around 8%. If the company is going at least 8%, now it ranges depending on the company. Some technology companies, they're smaller, they grow a lot faster. Some utilities and railroads and consumer products companies, they grow slower. But in general, 8% is at a minimum I want to see consistent growth. Dividends. Dividends are things you get from owning a company. So I used Apple as an example. Let's say Apple sells a phone for $1,000. It's revenue. Apple has a profit of, say, well, Apple has expenses of, let's just say, $600. And then Apple has a profit of, say, $400. Of that $400, Apple takes a little piece every year and they pay you in the form of a dividend. You want to get that money because that's your cash flow. Remember, you don't really make a lot of money until you sell the stock. That's called capital gains. But in the middle, while you own the stock, every year, you want to be earning an income to compensate you for owning the stock. And that's where dividends come in. That's called dividends. You want a company that's paying you increasing dividends every year. It's the same thing with earnings, same thing with your salary, same thing with money you make. You want it, you want it to be going up every year. As a result, you want a company that pays you also somewhere around 8% growth rate in dividends every year. And that's a good rule of thumb. Low debt. You don't want a company that has too much debt, too much leverage. And the reason why is, remember we talked about a recession, what happens? Everybody, apart from maybe Amazon and Uber Eats, companies like that, during this recession, most companies were hurting. Revenue dropped. If your revenue drops and you have very high debt, guess what happens? You got to pay the debt. The bank needs their money, right? They need their money on time. So if you buy a company that has a lot of debt and you have a recession, there's a good chance the company goes bankrupt. So you want a company with low debt or lower debt. A maximum should be somewhere around 70% of the equity capitalization. You don't want a company that has too much debt so you don't lose money. What else? Credit rating. This goes hand in hand with debt. Having a company that has a very good credit rating is a way to vet out companies when you look for companies to buy. Moody's, S&P 500, so S&P, Standard & Poor's, and Fitch are credit rating companies who, they do a lot of work on your behalf to vet companies to see if they have good credit rating. And usually, I think investment grade is somewhere around triple B minus and higher. So typically, unless you have a specific reason to, or your financial advisor tells you to, you want to stay away from companies that have less than triple B minus rating, because they're called speculative junk bonds. The bonds are called junk bonds. They have less credit rating. And so that's those are the things. Now, I've talked about a lot of things. Many of you are wondering, well, how am I going to go do all that research, David? How am I going to ever figure out how to buy a stock? I have a job. You just gave me another job. And when you buy a stock, you don't just buy a stock and hold. You have to keep doing research. And so you're wondering, how am I going to do all this? So I'm going to give you a rule of thumb, some very easy ways for you to figure out whether a stock is a good stock, whether a stock is a bad stock. Now, let me give you a disclaimer. All those things I've said, you want to do research on. But if you didn't have any time, and if you close your eyes, peek and pick a stock, I can give you 1 or 2 rules of thumb about how to pick a good stock and how to pick a stock that's too expensive. And so those 2 things are price earnings ratio versus the growth rate, and the dividend yield versus historical dividend yield. Let's start with the first one. I know those are big terms. Don't worry, I'll explain all of them. I'll break it down for you. That's why you got the chalkboard over here. I'm sorry about the makeshift chalkboard. It's quarantine time. I didn't have any time to buy. I got lights. I got all this equipment and stuff. I didn't have a lot of time to go out and buy easels. So I grabbed Logan. Logan's my bonus son. I grabbed his little easel, and I'm gonna write on it. You have a makeshift thing over here. So I apologize. When after quarantine, we'll have a lot more professional looking stuff. But for now, I just wanted you to understand the concept. The first concept, I'm gonna give you two rules of thumb where you can pick a stock within, I'd say, 3 or 4 minutes. And the chances are it's a pretty good stock to buy, or it's a cheaper stock to buy. Let's just say, not necessarily good, but it's cheaper or more expensive. So the first is price earnings ratio to growth rate. Let me explain. You're gonna compare two numbers. One is the PE ratio, and the second is the growth rate of a company. The PE ratio, what we call price to earnings ratio, is a multiple that most professional advisors use to value a stock. So for example, you want to buy a piece of land in, say, Texas, and it's $200 a square foot. $200 per square foot. $200 per square foot. You want to buy a piece of property in LA, so maybe it's a little bit more expensive. So you pay $400 per square foot. $400 over 1 square foot is how you judge real estate. The same thing with a stock. The price that a stock is trading at, let's just call that $10, divided by the earnings, the income, every dollar of income of the stock gives you what you call the price earnings ratio. Now, what's the price? If you go on your computer, type in price of Google, price of Apple, that's the price. That's how much it's trading at, $400 per square foot. What's the earnings? The earnings is the revenue of the company minus expenses, that's the profit, divided by the total shares outstanding. So I gave you an example earlier. Apple makes $1,000, right, in revenue. Let's say for one phone, let's say they have $600 in expenses, and they have $400 in profit. Let's say Apple, just for the sake of this argument, has only 400 shares outstanding. What's the number of shares they have? What's the price per share? What's the earnings per share? They made $400 in profits. They have 400 shares outstanding. It's 400 divided by 400. It's $1. That's what you call earnings per share. So when you take the price of the stock, how much it's trading at, and you divide it by the earnings per share, that's a formula we call price over earnings, PE ratio, price to earnings ratio. You just learned something today. Price over earnings equals PE ratio, price over earnings ratio. So you take that number, and that's expressed usually as a multiple. And you compare that number. So in this case for Apple, let's just call that $1. Let's just call that, let's say Apple is trading at, it's about over 300, but let's just say Apple is $10. So you divide 10 by 1, right? You get 10 times earnings. So if Apple is trading at $10, which it's not, but let's say it is, and it makes $1 a share, that's $10 divided by 1. The price earnings ratio is 10 times, 10x we call it. Then we compare that to how much we expect Apple to grow over the next 3 to 5 years. Let's assume we expect a growth rate of, for the sake of this argument, 20% per year. If Apple is growing 20%, its earnings, 20% growth every year, we want a stock whose PE ratio is equal to or less than the growth rate. That means you're getting a deal. If a company is growing at 20 times per year, 20 times, it's growing 20% every year, 20% every year in earnings. And I have to pay, my PE ratio is less than 20 times. I got a great deal. If it's more than 20 times, if I have to pay more for a stock that's straight, if I have to pay more than the growth rate, then it's too expensive. So let me try to break it down for you a little bit. In the example I just gave you, Apple would be trading at 10 times PE ratio, is growing at 20% per year. What? It's a great deal. 20 growth rate, 10 PE ratio. If Apple was growing at 5% per year, its earnings, and it was 10 times PE ratio, it'd be too expensive. So one way to judge a stock really quickly, to pick a stock that's cheap or a stock that's expensive, is to compare its PE ratio to the compound annual growth rate, the growth rate of the stock. Let's talk about some specifics. Many of you are wondering, yeah, that's a lot of numbers, Dave. Give me some real hard numbers. I'm going to give you two companies today. One is called Micron. One is called Chipotle. Micron is a semiconductor company. You know how you have a computer or a phone. Inside of that, the engine of that computer, inside of that, it's called a microchip. It's a chip. Micron makes that, kind of like the same thing Intel does. And Chipotle, many of you love those burritos of Chipotle, right? And so Chipotle is it's a company where you go to buy food. Is Chipotle cheap or expensive? Just based upon our model of price over earnings versus the growth rate. Okay, let's look at it. I'm gonna grab my computer, I'm gonna grab my pen, and we're gonna walk through it now. So Chipotle, the stock price is currently trading at about $1,022, right? $1,022. I mean, sounds expensive, but be careful, because you never really equate value to price. The price could be so different from the value. The price is just a reflection of how much it takes to buy a stock. The value is whether or not that stock is worth it or not. So they're two different things. So let's just say the price is $1,022. What's the earnings of Chipotle? Chipotle's earnings, adjust this phone a little bit. Chipotle's earnings are, as EPS earnings, that's price per share, is about $11.22. I'm sorry, it's $11.94 today. Okay, so if you take 1,022 and you divide that into this, you get, adjust this phone a little bit. It looks like my phone is a little bit blurry. You get $85.70. This is called the PE ratio of Chipotle. Chipotle is trading at 85.7. Now, let's look at the growth rate of Chipotle. How do we expect Chipotle to grow over the next, say, 3 to 5 years? The growth rate of earnings is about 54.7. Chipotle is expected to grow at 54.7 its earnings approximately every year over the next 3 to 5 years. This came from Angus, a research company we use, and it's currently trading at 85.7. By our model, is Chipotle cheap or expensive? Questions? Let me see class is in session for y'all who don't like classes. Class is in session today. Okay, so is Chipotle cheap or it's expensive? Well, remember, if the PE ratio exceeds the growth earnings, exceeds the growth of the earnings, it's a little bit expensive. So Chipotle is expensive. That's an expensive stock to buy, right? Well, which one is cheap? Let's talk about Micron, right? Micron Technologies. Micron, as you know, does chips. They sell computer chips. And Micron close of market today was about 46. So price was about 46.7, somewhere around there. They closed at 46.7. The earnings is 2.02, right? So if you divide 46 by 2.02, what do you get? Micron is about 22 0.97. That's the PE ratio of Micron. How much is Micron projected to grow over the next 3 to 5 years? 46.57. All right? So if the PE ratio is 22 and Micron is growing at 46, almost double, is Micron cheap or is Micron expensive? Eva, Eve M, I see you got the answer on the last one. How about this one? Simon, is it cheap or expensive? It's cheap. Why? Because the growth rate is a lot more than the PE ratio, than the price. And with Chipotle, the growth rate is a lot less than the price earnings ratio. So it's pretty expensive. Questions? I see a lot of people on here. Castro, you got that. That's good. Hey, Simon, I see you got that one too. Congratulations. Okay, so that's the first thing. That's the first way that, if you close your eyes, pick a stock. And you can do this analysis. You can look at the price of earnings, get the multiple, it's called the P ratio, get the multiple, and then look at the growth rate, the estimated growth. You can get this on Yahoo Finance. You can get it on any research, Google Finance. You can get all these numbers on Yahoo Finance. You get all these numbers on Google Finance, right? If you forget these numbers, subscribe to my YouTube channel. Make sure to hit the subscribe button, and you'll be able to come back and review these. You don't have to take too many notes. I want you to listen. And when you compare that to the growth rate, it tells you really quickly what's a cheap stock or what's an expensive stock. Okay, there's one more I'm going to give you today. We're not done yet. Class is in session. So for y'all who don't like school, remember I told you, class is in session. Okay, the second thing I'm going to teach you on how to pick a stock is what we call, it's a current yield, dividend yield versus historical yield. Let me explain. Do you remember what I said about dividends? Dividends are pieces of dollars, money that you receive, pieces of a company's profit. Company makes a profit, like Apple. It makes, say, $400 a phone, as an example. It pays you every year something, $50 or $80, just to keep you happy. You take that money, you put it in your pocket, or you reinvest it, which I recommend. If you don't need the cash flow, if you're not retired, reinvest your dividends. So we'll come back to that some other time. But dividends are very important, right? And the reason why dividends are important is because they're cash flow that you get in your pocket every single year that you can count on. You can usually tell what's a good company and what's a bad company based on how much they're paying in dividends. So how can you tell whether it makes sense to buy a company based upon the dividends? There's this thing called a dividend yield, right? A dividend yield is very simple. It's the price of the stock, it's the dividends, the annual dividends, I can't even spell anymore, divided by price of the stock. Very straightforward. So in the example I gave you with Apple, let's assume Apple is trading at, what did we say, $10? And let's say Apple pays you a dividend of, say, remember they make a profit, they make a big profit. Let's say they pay you a profit of $2. The dividend yield will be 0.5, right? 0.5. This dividend, or 50%, I'm sorry, not 0.5, 0.2, 0.5. I can't even do math anymore. It will be 0.2, right? So, or 20%, which equals 20%. Okay, so how can you tell whether it makes sense to buy a stock based upon the dividends? Well, you look at the historical. You go back into history. You can get this on Yahoo Finance or any of the other portals finance portals out there. You look at the history of the dividends and you ask yourself, is the company paying me dividends now that are more than the historical dividend yield, or are they paying me dividends that are less? If they're paying you dividends that are more, that's great, right? That's good. You want that. You want the dividends to be growing. If they're paying you less, that's not so good. That's bad. So let me give you a few examples. I'm going to give you two companies now. One is AMC and one is AT&T. AMC is the entertainment company, the movie theater company. And the second one is AT&T. We all know AT&T. So AMC. Remember this formula, dividend over price? Okay. So let's look at it. How much is AMC paying in terms of dividends per year? 4.12, right? How much is the price? 4.66. So for those of you who are good at math, run those numbers real quick. The dividend yield, 2.54%, right? Is this good or bad? Historically, this is the historical performance. This is how much they paid historically. It's 9.5. So they're paying you 2.54 now, and historically they paid you 9.5%. 2.5% is a lot less than 9.5%. What happened? Why did they cut my dividends? That's my money. Why would they cut my dividends? Something is going on. And of course, we know that because of Netflix, there's a big decline in people going to movie theaters. Also, COVID-19 and a lot of other things have caused them to have reduced their dividends. So this is not very good. So this means AMC, in general, is expensive, right? Let's look at AT&T. Can you guys see, can you see the board? Let me make sure you can see the board. Okay, perfect. Let me look at AT&T. How much is AT&T's, how much is the dividend they're paying you? Right now, it's 2.08. Remember, 2.08, they're paying you $2.08. Oh, and always remember the price. You have to look at the price of the stock. Remember, you can get this on Yahoo Finance. The price of the stock is 29.59, right? What does this mean? AT&T is paying you about 7.18%. $7.18% is how much they're paying. What is the historical? Historical is 5.5%. So AT&T right now is paying 7% dividends, 7.18. Can you guys see that? Okay, 7.18. And historically it's 5.5%. As a result, AT&T is cheaper. Why? Because they're paying me dividends. They're giving me money. They must be making money. My income is going higher. Look, I could just sit back. I don't care what happens to the stock. I mean, you do really, but I'm just saying. Who cares what happens? If I'm making 7%, if I invest my money, I'm making 7% every year. I'm cool. I'm happy. I'm happy with that. So is AT&T expensive or cheap? It is cheap. So this is another way for you to judge what to buy, whether a stock is valuable, it's a good value, or it's expensive. One is by looking at the dividend yield. Well, one is by looking at the price equity ratio versus the growth rate. The second is by looking at the dividend yield versus the current dividend yield versus the historical dividend yield. Okay, I said a lot, but I promised you I'd tell you how to buy a stock. There's other ways, remember? I mentioned a lot of other ways to buy a stock. You know, there's the way we buy stocks, you know, we used to buy stocks on Wall Street. I used to work on Wall Street, is we would do what you call the discounted cash flow method. You know, we'd look at a stock over the next, say, 5 to 10 to 15 years, and then we'd project that number over the lifetime of the stock. And then we would discount it back using an appropriate interest rate, and we would get a number called the cash flow number. But you don't want to do that. That's a lot of work. Usually you want a rule of thumb. So I'm just giving you 2 rules of thumb today. and hope that's the price of admission, right? I want to stop for a second now, and I want to get a little serious. Should you even buy a stock? Should you go out and buy a stock? Maybe not. And here's why. Or maybe you do, maybe you don't. Here's why you may want to think about whether or not you should go out and buy a stock. When you buy a stock, remember what I said. You have to understand the product or service. You have to make sure it has low debt. Make sure the dividends are increasing. Make sure the earnings are increasing. Make sure the credit rating is good. Make sure. There's so many things you have to look out for. And you have to keep doing the research every month. You have to understand its competitors. You have to understand whether there's a better deal out there, because you have a good company doesn't mean there's not a better company out there. Because you have Google doesn't mean Apple is not a better company, and vice versa. If you have limited funds, you may want to use your money to buy something else. So you have to keep doing research. For many people, they don't want to do that. Many people just prefer to let somebody else do the work. And a few decades ago, this thing called mutual funds came into play. And mutual funds are what I'd call a collection, a basket of stocks. I'll give you an example. Let's say you want to buy Apple. Apple is great, but then you don't want to do the research. So you decide, you know what? I'm going to buy a mutual fund. You buy a technology mutual fund, which may have Apple, Google, Facebook, Yahoo, Alibaba, and a lot of other stocks in there. And you pay just one price for it. You don't have to do too much research. You just bought a mutual fund, which is great because you could still make money. You could still make the same thing you make with stocks, but you have a better diversified portfolio. What's diversification? Let me give you an example. Let's say a lot of people called me over the last few months and said, you know what, Dave, I want to buy airlines because they went down in price. And so let's say you buy a company like Delta. It's a big company. So I think it's the largest now in the US by air traffic. Let's say you buy Delta. Let me ask you a question. What are the chances Delta goes bankrupt? Maybe not high, but there's a chance. Let me ask you another question. What if you bought Delta and American? What are the chances they both go bankrupt and you lose all your money? Is it less or more than just buying Delta? Of course it's less, because for two big American companies to go back, two big American airlines to go bankrupt, that's rare. What if you bought Delta, American, and Southwest, and Alitalia, and JetBlue, and you put them all to, is JetBlue still out there? Yeah, I think it is. You put them all together in one basket. What are the chances they all go bankrupt? Very, very slim. Very, very slim. So the reason why you may want to buy a mutual fund or a fund is not only because you don't have to do all the work, which you have to do when you buy individual stocks, it's also because you're better diversified. So the chances you lose all of your money are less. Now, over the last couple of decades, this thing called index funds came into play. An index fund, and they kind of took over from mutual funds. What's an index fund? And why is an index fund so cool? Many of you have heard about this thing called index funds, right? Well, I'll tell you what. Those mutual funds, the stocks in those mutual funds, American, Alitalia, and all those things for, the ones that are for airlines, or the ones that are, all those things, there's a lot of work that goes into picking those stocks. There's an investment manager and his assistants who they do a lot of research. The same research I just showed you, they do it every day. They're analyzing stocks. They have a Bloomberg machine. They have a Quotron screen. They have staff. They go visit the companies. They have conference calls. They spend a lot of time. They got big offices. They're in all kinds of fancy parts of downtown LA and all kinds of fancy parts of downtown New York. And they're spending a lot of money. They're doing a lot of research to make money for you. The problem is, a mutual fund often underperforms an index fund. An index fund is a basket of same type of basket of stocks, only nobody's trading them. There's no boss, there's no Quotron, there's no Bloomberg machine, there's nobody in a high tower who's filling out forms, who's analyzing deals and making all this stuff happen. There's nobody, there's no guy or gal who's doing that. It's just a basket of stocks a company has put together that includes, say, airlines, all airlines, or all technology companies, or the S&P 500, or all of the companies in America, or called the total stock market, or all of the companies around the world. Someone, a company, has put together a basket of different types of stocks, and nobody manages, they just stay there. And so if you invest in an index fund, you aim to make the average return, which is around 8 to 10% overall in the US per year, goes up and down sometimes, but about 8 to 10% per year. If you buy an index fund, you're aiming for the average, but the average is good. And I'll tell you why. You go back to a mutual fund, those fancy big buildings and high towers, 75% of those mutual funds underperform in any one given year index funds. Let me repeat. You know, the fancy analysis and all that stuff, the big high towers, it costs money. So those people might be geniuses, and I knew a bunch of them. You know, I knew Gary. You know, I met Jeff Binnick at Fidelity. He came to speak to us at Harvard. Miller. You know, there's some very, very smart people. You know, who make money from stocks, buying individual stocks, but the cost of it very often makes those funds 75% of the time underperform an index funds. Average is good. Go for the average if you can. If you don't want to do all that, if you don't want to take the time to pick the 25% of active managers that will outperform the index, go for the index. But I got something else better for you. Index funds, especially when they're sold as a mutual fund, there's index mutual funds. Something else came out, you know, less than a decade ago called exchange traded funds, right? And a lot of people have been gravitating towards exchange traded funds. Why? Well, exchange traded funds are almost exactly like index funds. You remember index funds are, in many cases, for most people, actually better because they're cheaper than mutual funds. Well, these index funds, there's something called exchange traded funds, which has one advantage over an index fund. Still the same cheap price versus a mutual fund, but they traded every day like a stock. So you can go online and you can buy an ETF, and you can buy an ETF for yourself right now. With a mutual fund, you have to wait till the day is over. So you don't actually know what the price you're buying an index fund is. So very often, many people, especially professional managers, gravitate towards index funds, towards exchange traded funds, because we not just get the cheaper index funds, but we get them when we want them and we know what the price is, instead of waiting for the price to be settled at the end of the day. Woo, that's a lot. We've talked about, you know, how to pick the things you look at when you pick a stock. We've talked about, I gave you 2 mechanisms to pick a stock real quick, you know, a cheap stock or an expensive stock. And I told you about the difference between mutual funds, index funds, and exchange traded funds. But we're almost done. I have one more topic for you about stocks, and that's, where do you buy? I've heard so many people call me, hey, we do stocks, by the way, we're financial advisors, but, you know, we're so busy now, we're not taking any more clients for about a month. You know, so even though I can't work with you for a month, there's a lot of other places that you can go to work that'll work for you. And many of those places are divided into 2 categories. There's the online brokers, and there's the financial advisors, the ones who you go to, you sit in their office, or they come to your house, at your kitchen table, they give you advice, and so on and so forth. Which one should you use? Should you use an online service like Robinhood or Schwab or TD Ameritrade? Well, TD Ameritrade and Schwab are actually going to be the same company going forward because they're merging. But should you use an online broker, or should you use a financial advisor? That's going to be up to your circumstance. And this is the final part of what we're going to talk about. What an online broker, discount brokerage is the advantages are, one, it's cheaper because they don't have all these, you know, salespeople who they have to pay commissions to. So in many cases, they're cheaper. You can go online and you could do your own research. And you could, if you know what you want, if you're an experienced investor, you can actually go to a company like Robinhood or Schwab, or TD. You could pick a stock, you could pick a mutual fund, pick a stock, and you can buy it. And you can do it yourself. Many of those people like Robinhood, you don't even pay them a commission, right? It's free, so to speak, because they actually use your money, your cash. They actually use your money to make money, but they don't charge you anything extra. And so the first advantage to using a discount broker or an online service is it's cheaper in general. And number two, it's always there. If you want to buy a stock, you go online, you can buy a stock. You want to sell a stock, you don't have to call some guy, in LA or a guy in New York because, who's not available, he's on vacation, so you can always do it. So it's cheaper and you can do a trade anytime. It's easily accessible. Those are the two advantages. So if you don't want to pay too much, you don't want to pay extra, and you want what you need when you need it, which means a stock, why would you ever use a financial advisor? Well, you use a financial advisor under one circumstance, when you need advice. If you're smart, financially savvy, you know what you want, you know what you're doing, you know your research, you know what, but go to an online broker. But if you need advice on what type of stocks to buy, how to diversify, you need advice on not just stocks, but estate planning. How do I protect my children? On college education planning, what type of life insurance should I get? What type of, how much should I put in my retirement account? How much do I need for retirement? If you need advice, if you're at a point in your life, whether you're just starting off or you're in the middle or you're towards the end, you want to plan for Social Security, medical expenses that, while you're older, you may need to call. That's when you actually need a financial advisor. And if you go to if you go online and the first place I recommend to get a financial advisor is to ask friends of yours, who have advisors, or your CPA, people who are they're happy with their advisor. Ask them, because the chances are, your friends are probably similar to you, and if they're happy, let me draw that curtain. Seems like the sun's coming in. If you're happy, if they're happy, you're happy too. But if you don't have that opportunity, you can go online and you can go to FINRA, Financial Industry Regulatory Authority. Go to their website. They have a list of brokers you can pick, and there's a lot of other ways that you can find a financial advisor. So in general, if you're a more financially savvy investor, you know what you want, and you don't need other advice, you should go online and pay less. But if you need advice, you need help with someone to guide you and someone to show you the ropes, you may want to lean towards a financial advisor. Wow, we've covered a lot today. And so I'm going to see, should we take any questions, tech team, or should we just, because I think we have we have about 2 or 3 minutes. Do you want to take maybe one or two questions before we go? Wow, there's a lot of questions over here. Someone said, do we take an internship in Houston? We don't have an office in Houston. We have an office in Fort Worth, Texas. We have an office in LA. We had offices all over. We had New York, we had Woodland Hills, we had a lot of other places. But now with technology, you don't even need an office. I'm at home, and I'm working and we're busy. So now with technology, we shut down most of our, we only have 2. And pretty soon we're going to have just 1, probably just LA. And pretty soon, hey, maybe I'll be working virtually. Maybe I'll be coming to you, to your city pretty soon. So let's see, which other questions do we have? Yes.
Question from Liz E.T. She says, why is the stock market picking up when unemployment and inflation are lurking?
That's a great question. The question was, unemployment is very high. People are hurting. People are not buying. The economy is in the tank. There's a recession going on. What's going on with the stocks? Stock market dropped by 34, 35%. Now it's back up by 30%. What's going on? Well, it's a simple answer after all. The stock market is what you call a forward-looking instrument. The stock market doesn't look at today's value, what's going on in the economy today. The stock market looks at what stocks and the economy and the market is expected to do in 2 years, in 5 years, in 10 years, in 50, and down the road. So by stocks picking up, that's a positive sign that investors feel that this recession is going to end one day and things are going to be better. And you know, the reason why that question, I hope I answered your question, but that question is even more pertinent today because it's a guide to what you should do and what you shouldn't do when things get bad in the economy. As you know, stocks plunged by 30, 35, some stocks by 50, some stocks by 7, some airlines and cruise lines and oil companies were down 70, 80%. Why? And then it came right back up. Imagine what happened to those people who sell. How did they feel when they sold 30%, 40% down, and then it came right back up? That should be an indication to you that there's this thing called panic. And panic is what happens when people get scared and they sell. I'm going to end this with what my hero, Warren Buffett, once said. Be fearful when others are greedy, which means when everyone's buying, you stay on the sidelines. Be greedy when others are fearful. So when the stock market was crashing a month ago, I was telling you to be greedy, to buy, buy, buy. The stock market now is back up 30%. It's going to happen again. Every 8 to 10 years, we have a recession. We're going to have another recession. Remember this. The stock market again will plunge more than 20%. That's called the bear market. Do not panic, because when others are greedy, when others are fearful, you be greedy. Bye. It's a pleasure. Nice talking to you. Thank you for joining me. I'll see you next week. Next week, we'll talk about bonds. Please don't forget to subscribe. Don't hit if you have the gray button, that's good. If you have a red button on YouTube, you should subscribe and tell your friends that David is teaching them how to become one of the 1%. From the 99%. Next week, we're going to talk about bonds. I'm going to break bonds down. What's a bond? Why should you buy a bond? Why do bonds go up and down? How do interest rates affect bonds? What's a US bond? What's a treasury bond? What's a corporate bond? Should I buy bonds? Should I buy a mutual fund? Should I buy an index fund? What is a bond? I'll answer that question for you next week. Thank you for joining me. Look forward to seeing you next week. Don't forget to hit subscribe. I'll see you soon.